You've seen the posts, the laptop on a beach, the supercar steering wheel, and the promise that a few clicks a day will set you free. The data suggests a different reality. 95% of retail day traders lose money consistently, year after year. Most beginners approach the charts looking for a prediction. They treat a price movement like a coin toss, often confusing a lucky guess for a repeatable strategy. Many experience a brief winning streak early on. A few trades go their way, they make a quick $500, and their confidence outpaces their skill. When the market inevitably shifts, that same ego leads to a rapid total loss of their starting capital. For the vast majority of people, the stock market functions like a casino. It is a system that effectively harvests capital from those seeking a fast dopamine hit. Both the failing majority and the thriving 5% look at the exact same screens. They have the same 24 hours in a day, the same candlestick charts, and the same global economic news feeds. High intelligence offers no inherent protection from failure. Highly educated professionals, doctors, engineers, and researchers frequently destroy their accounts because the skills required for academic success don't always translate to the trade floor. Since the tools and data are identical for everyone, the differentiator isn't found in the depth of the financial analysis itself. A perfect chart setup is accessible to anyone with an internet connection. The real divide exists in the psychological execution. The market provides the data, but the trader's own internal operating system often determines whether that data leads to a profit or a total account wipeout. The human brain is wired to seek structure and predictable outcomes. This trait clashes with financial markets, which are inherently chaotic and offer no guarantee that a specific input will lead to a specific result. To manage this uncertainty, many traders fall into a trap of adding layer after layer of information. They stack moving averages, RSI levels, and Fibonacci grids, believing that more data will eventually eliminate the unknown. This search for certainty often leads to analysis paralysis. By consuming conflicting news reports and social media opinions, the trader loses the ability to make a clear, decisive move. In this environment, more information often degrades the quality of a decision. Once a certain threshold is crossed, the extra data only serves to increase confusion and accelerate failure. In most careers, you wait weeks or months for the results of your work. Trading provides a financial consequence seconds after you click a button. An immediate loss can trigger a state of shock. This physiological response can override the prefrontal cortex, leaving the trader operating on pure instinct. Under this stress, traders often abandon their original plans. They might widen their stop losses to avoid the pain of being wrong, or enter reckless new positions to try and win back what they just lost. While the majority of traders stay trapped in this cycle of panic, the successful few have trained themselves to view these real-time price fluctuations as secondary to their long-term process. Compare a trader who overanalyzes 40 different indicators with someone who executes a simple 3-rule system. One is searching for an elusive perfection. The other is simply running a probability model. That model relies on strict risk management. Risking exactly 1% per trade ensures no single loss is ruinous. Expecting frequent losses, even a 50% win rate, remains profitable because the average winners stay significantly larger than the losers. Professional trading functions as a business of managed losses. It requires a commitment to following a statistical edge rather than the pursuit of a perfect prediction. Most people judge their trading by their daily profit and loss. This focus makes their confidence dependent on the market, which is something they cannot control. The successful 5% shift their focus to the process. They define a winning day by how well they followed their rules, regardless of whether the account balance went up or down. Taking a loss on a trade that met every entry criteria is considered a successful execution. Conversely, making money on a trade where the rules were broken is viewed as a failure of discipline. Detaching self-worth from the daily outcome is the primary mechanism that allows a trader to stay consistent over the long term. The unspoken reality of professional trading is that it is often quite boring. It involves long periods of doing nothing while waiting for a specific set of conditions to appear. This requires strategic ignorance, the discipline to ignore the news, the social media hype, and the opinions of others, focusing only on the execution of a single mastered edge. The market rewards those who stop fighting its inherent uncertainty. By simplifying the approach and executing with robotic discipline, the impossible becomes a repeatable routine.